In the last 48 hours, we saw this massive spike in global energy costs. And, normally that triggers a market-wide panic.
Oh, absolutely. Total panic.
Right. But instead, Wall Street just shoved billions of dollars straight into large tech stocks. And meanwhile, major U.S. executives quietly took on record amounts of new corporate debt. So today we are doing a deep dive into the reports to figure out exactly why the smartest money is aggressively bracing for a storm.
Yeah, even while the surface of the market looks perfectly calm to the rest of us, it really is like watching a tectonic fault line. I mean, the macro pressure builds up silently over time.
Yeah, inflation rates, all of that.
Exactly. But the actual capital migration happens in these sudden, violent earthquakes.
Which brings us to the trigger for this specific earthquake, which was oil. Since you track these markets so closely, an energy spike acts as an immediate tax on physical supply chains.
Right, it instantly compresses margins.
Exactly. For any business moving atoms instead of bits, it gets expensive fast. But the knee-jerk reaction is what's fascinating. Investors didn't retreat to cash. They reflexively sheltered in large tech companies. It's almost like they treat big tech as this financial bunker.
A financial bunker is a great way to put it, actually.
I mean, my read is that this is an asset-light play, right? Because software margins are practically immune to freight costs. But, is there a liquidity aspect happening here too?
You hit the nail on the head with the asset-light model. I mean, big tech companies operate with near zero marginal costs. So if oil hits, say, $100 a barrel, it doesn't really cost them any more to distribute a software update.
Right, they are structurally insulated from physical inflation.
Exactly. But yes, the liquidity premium is definitely the other half of the equation here. In times of sudden uncertainty, institutional money just craves these massive, highly liquid havens.
Places where they can park billions without moving the underlying price too drastically, right?
Precisely. And tech provides that scale.
Okay, so retail money is chasing that tech shelter. But institutional money, specifically corporate executives, they were doing the exact opposite. They aren't hiding. They're actively leveraging.
Yeah, the data shows a massive surge in new bond issuances. I mean, they are borrowing billions right now.
And I have to push back on their logic here for you, the listener, because it seems weird. If you see a macro storm coming, leveraging up your balance sheet with new debt seems, incredibly reckless.
On the surface, sure, it looks like terrible timing, but from a CFO's perspective, it's really a race against the clock. They aren't borrowing to expand.
They're borrowing to survive what comes next.
Exactly, because when true economic uncertainty sets in, credit markets just completely freeze up. Lenders suddenly demand significantly higher yields for the perceived risk.
So it's a yield play. They see the writing on the wall and realize the cost of capital is about to skyrocket.
Right.
So locking in a relatively cheap fixed rate today is actually a defensive maneuver, not an offensive one.
It's securing your umbrella before the downpour starts. Because, once it's raining, the price of umbrellas quadruples.
That makes total sense. Which brings us to the domino effect. If executives are actively pulling forward their financing because they expect credit to dry up, that's going to ripple out to the broader economy.
Oh, without a doubt. That kind of aggressive, defensive posturing usually precedes a massive volatility event.
Like a surprising market rally if the pressure unexpectedly releases or, a sudden sharp correction.
Right, and that's exactly why the institutional players are laser focused on three specific signals right now. They want to measure the pressure on that fault line.
Okay, what's the first signal?
First, obviously, is the ceiling on oil prices. Basically, how high does that supply chain tax go?
Makes sense. And the second?
Second is corporate borrowing rates. They are watching how quickly the cost of capital is actually rising.
And the third signal?
The secondary flows of institutional money. Once capital eventually leaves that tech safe haven, where does it hunt for yield next?
Wow, it completely shifts how you read the tape. The real story isn't just that oil went up and tech went up.
No, not at all.
It's about a fundamental rewiring of institutional risk in real time. We are literally watching the architecture of the market shift underneath our feet.
And, the next few months will reveal whether this was just a tremor or the big one.
Which leaves you with the thought to mull over as you look at your own portfolio. If the world's largest, most well-capitalized corporations are urgently paying premiums to lock in their financial safety nets today, how insulated is your own financial architecture if the credit markets actually do freeze up tomorrow?